Collision, one bad algorithm wiped out $440 million in just 45 minutes. And it wasn't a human mistake. It was AI. This is not science fiction. This is real finance. And it happened to one of Wall Street's biggest trading firms. Today, we'll uncover shocking real-life cases where artificial intelligence in finance went terribly wrong, causing massive financial losses. And most importantly, the critical lessons every investor, business, and policymaker must learn. Stay with me for the next 30 minutes, because what you'll discover might change the way you trust technology with your money. Welcome back to the channel where we decode the intersection of finance and technology. AI has revolutionized trading, investing, and banking. But sometimes, the same powerful algorithms designed to make us rich can cause devastating losses. Remember the Knight Capital disaster in 2012? A single software glitch cost the company almost $500 million in less than an hour. And that was before the latest wave of AI sophistication. By the end of this video, you'll understand what went wrong, the red flags we missed, and how to protect yourself and your business in the age of machine-driven finance. Host: Artificial intelligence in finance isn't new. In the 1990s, algorithmic trading started using early machine learning. By the 2010s, high-frequency trading accounted for over 50% of U.S. equity trades. Today, generative AI and deep learning models design investment strategies, detect fraud, and even approve loans. AI has delivered extraordinary efficiency. McKinsey estimates AI could generate $1 trillion annually in added value for banking. But when AI goes wrong, the impact is equally massive. Why? Because AI operates at speed and scale humans can't match. A single flawed model can move billions of dollars in milliseconds, spreading risk across global markets before anyone notices. Real-world data shows over 60% of large financial institutions have faced at least one AI-related operational incident in the past decade. And some of these were catastrophic. Let's start with one of the most infamous examples. Knight Capital, August 2012. A faulty trading algorithm mistakenly flooded the market with unintended orders. In just 45 minutes, Knight lost $440 million. Forcing an emergency rescue. Why did it happen? Poor testing of new software. Lack of fail-safes. No real-time human oversight. Think of it like a self-driving car that suddenly accelerates on its own, and no one can hit the brakes. This case became a wake-up call. AI needs human backstops and rigorous testing before deployment. AAP sak rahi hong. Ya surf ek company ka problem na? Bilkul nahin. On May 6th, 2010, the U.S. stock market experienced a flash crash. In minutes, the Dow plunged nearly 1,000 points, wiping out $1 trillion in market value, before rebounding within 20 minutes. High-frequency trading algorithms amplified the sell-off, feeding on each other's signals. No single human or company caused it. AI-driven trading bots interacted unpredictably, creating chaos. Billionaire investor Warren Buffett later warned, "It's like an electronic herd. Once it starts running, no one knows where it will stop." This shows how interconnected AI systems can create systemic risks, a problem regulators are still struggling to solve. When AI bias meets finance host. Not all AI failures are sudden crashes. Some are slow, hidden, and just as damaging. Consider AI-driven credit scoring. In 2019, Apple's credit card algorithm was accused of gender bias, offering women lower credit limits than men with similar profiles. Several banks have faced lawsuits for discriminatory lending decisions made by opaque AI models. Pros and cons. White heavy checkmark pros. Speed and efficiency in loan approvals. Crossmark cons. Hidden bias, reputational damage, and legal risks. A short analogy. It's like a GPS that subtly misdirects you every day. Not enough to notice immediately, but enough to take you miles off course over time. Host. So, what does the future hold? By 2025, Analysts predict over 80% of global banks will deploy advanced AI for risk management and trading. By 2030, AI-driven trades could represent two-thirds of all global equity transactions. But with great power comes great risk. AI models could be exploited by cybercriminals. Model collapse, where AI trains on AI-generated data, could create blind spots. Black swan events could trigger another flash crash, only faster. What if, in 2030, multiple AI systems across the world misinterpret a geopolitical shock simultaneously? Markets could free fall before humans even wake up. AI is no longer just a tool. It's a force that can move trillions of dollars. When it works, it's transformative. When it fails, it can be catastrophic. The lesson? Human oversight isn't optional. Regulation and transparency are critical. And as investors, we must understand the technology we rely on. Your big takeaway: trust AI, but never blindly. If you found this analysis eye-opening, like, subscribe, and comment below with your thoughts. Backhand index pointing right, do you think AI risks will ever outweigh the rewards in finance? I'd love to hear your perspective.